Welcome to this course on advanced gap trading. In this lecture, I'm going to go over the very basic ideas behind gap trading. And if you've taken my gap game plan course, you can easily skip this lecture without losing any material. All I'm really going to show is what a gap is, and then later we'll do the more practical steps of finding gaps and charting it and all that stuff. But let me just go over the basic idea of what a gap is. I'm going to go to Yahoo Interactive Charts, and I'm going to chart a stock. We're just going to look at Yahoo, why not? Alright, so here's Yahoo in the past month. Alright, it looks like the stock price went down, and then went up, and then kind of trailed sideways, slowly went down. It looks continuous, right? But it's 100% not continuous. Because the stock market isn't open 24 hours, and even if it were, that's just not how the stock market works. The price tends to jump from one spot to another, and we can't really see this when we're graphing it through a line chart. So what we have to do is switch to the candlesticks. Now, by looking at it for the term of a month, when we select candlesticks, what we're actually looking at are the daily candlesticks. A red candlestick means that the price started above and fell. A green candlestick means that the price started below and rose. Now, the candle itself, you can see there's shadows. It's kind of hard to see here, but there's going to be a shadow, which shows the max, and there's a shadow that shows the min. Now, if you're using interactive charts from Yahoo, you can see at the top left there's a little box that gives you those statistics: the open, close, low, and high. The idea of a gap, you could probably see that there's a big space here, a big space here, and a big space here. The idea of the gap is when a candlestick's wick, the bottom wick or shadow, doesn't touch the previous day's upper wick or shadow, or the day's top wick or shadow doesn't touch the previous day's lower wick or shadow. It doesn't matter whether the candlestick is below or above the previous day, it's still a gap. So we differentiate these two gaps by calling them either an up gap, in which the candlestick of today is higher than that of the previous day, or a down gap, in which the candlestick of today is lower than that of the previous day. Those are gaps. And the meaning of that simply is that the closing price of yesterday was not touched again today. Now, there's some statistics on how gaps work, and we're going to be relying on those statistics to trade. And I've done a lot of back testing with gaps, and I find that gaps can be very profitable if played correctly. Now, in the gap game plan, if you did take the gap game plan course and you're watching this, I need to tell you to throw some stuff out the window for a bit, because it's not going to be appropriate for this gap trading strategy. Let me show you what I mean here. Alright, so if you did the gap game plan, we talked about breakaway gaps and area gaps. Let's look at area gaps first. The idea of an area gap is that the gap will always fill, so that eventually this little space here will be filled by candlesticks, and that happens on day 6 or so. For this particular stock, it happened on day 6. Now, I gave you a lot of info in the gap game plan as to how to recognize an area gap versus a breakaway gap, which I'll show you now. Here's a breakaway gap. The difference between these two is that the breakaway gap tends to have higher volume. The new candlestick tends to be very far away from the old candlesticks. And the implication of a breakaway gap is that the price will continue in that direction, away from the gap, whereas a area gap will close. I told you that in the gap game plan. Now I want to tell you that we're going to ignore breakaway gaps. We're going to treat all gaps, whether they be area gaps or breakaway gaps, as area gaps. We're going to assume that all gaps close. That's the assumption we're making. Now you might be thinking, wait, in the gap game plan you said that breakaway gaps are going to widen and we want to bet put, or we want to bet in the short direction. Why are you telling me in this course that we want to bet in the long direction? Well, because in the last course, we had exit strategies that were time-based or price-based or candlestick-based that got us out of the trade quickly. The idea is that you never want to stay in a breakaway gap trade a long time because almost all gaps close. Statistically, the vast majority of gaps will close. So there really isn't such thing as a breakaway gap. Breakaway gap is simply an area gap that widens before it closes. Okay? And this one's a little more special, but I bet you within 30 days this one probably did close unless it's just one of those weird events, those black swan events where something really bad happened in that stock. And if you wanted to avoid those events, all you'd have to do before trading a stock like this is just look at the news for that date and see if something really weird did happen. Generally, it's going to be an overreaction, and generally, it's going to close, okay? Generally, it's going to be an area gap. So that's what this course is based on. We're going to make money by playing area gaps, and we're going to treat all gaps, even breakaway gaps, as area gaps. But I'll give you some rules on how to be careful, and I'll give you some rules on when to get in and when to get out so that we're profiting pretty much on every trade. Okay, so that's the basics of a gap. What you really just need to know is how to read these candlesticks and recognize a gap. And everything in the following lectures will guide you through the rest of the process. So just as a recap, a gap is formed when the low of one day is higher than the high of the previous day, or when the high of one day is lower than the low of the previous day. Okay, so in either of those cases we have a gap. This one's an up gap, and this one's a down gap. The candlesticks are going to be red and green. Some people will call them white and black. White corresponds to green, red corresponds to black. The only real difference between red and black are that for red and green is that for red, the top of the candlestick right here, not the wick, but the top of the bar itself, is the opening price, and the bottom is the closing price, whereas for the green one, the bottom is the opening price and the top is the closing price. So the green one indicates price movement upward during the day, and the black one, or the red one, indicates price movement downward during the day. And the colors of these candlesticks are going to be important, as you'll see later in this course. But for now, just be sure that you understand how to read a candlestick chart and you should be good.